Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the Chapter 7 short exercises that were assigned in the digital study guide for you to do at the end of the chapter. And note, accounting is about understanding the concepts and then applying that understanding to the situation at hand. If you get the application aspect wrong, that is one thing and is easily remedied by watching someone else work the problem. However, if you don't understand the concepts, that is a whole other thing. Watching a problem worked out will not help if you do not understand the underlying concepts. Go back and study the text material again and watch the theory videos. If you still don't understand the concepts, then either email or telephone an instructor to get help with that understanding. All right, so let me scroll down here to, we were working on problem 7-8. Okay. All right, percentage of sales, allowance method. All right. During its first year of operations, Worldwide Travel earned revenue of $620,000 on account. Okay, so that's earning revenue, right? That's our, sales revenue. And then since we're working with a percentage of sales, the $620,000, and it's on account. Obviously, we're writing off our debt, so it's our credit sales. Okay, so that's $620,000 on account. Industry experience suggests that Worldwide Travel's uncollectible accounts will amount to 3% of the revenues. On December 31st, accounts receivable totaled $177,400. The company uses the allowance method to account for uncollectibles. So remember, you have the direct write-off method or you have the allowance method. And if you have the allowance method, you can either use the percentage of sales method or the aging method. So in this case here, they're telling you, oh, we're not using direct, we're using allowance. And in the allowance method, we're using the percentage and not the aging. Journalize Worldwide Travel's bad debt expense using the percent of sales method. Okay. Show how Worldwide should report accounts receivable on its balance sheet on December 31st, 2014. All right, so we have to do the calculation first for a percentage of sales method. If I have 620,000 and I take 3% of it, that means I'm going to have 18,600 as my estimate. So my journal entry is going to be a debit to bad debt expense for the 18,600, and I'm going to credit my allowance for uncollectible account or allowance for doubtful account in the amount of 18,600. And the description would be, to record the estimate of uncollectible accounts for the year. Right, so that's the journal entry. Now it says here, how should the accounts receivable be reported on the balance sheet? So let me, okay, so on your balance sheet, you're going to have your accounts receivable account, and it's saying that that was 177,400, and then you would have less your allowance for uncollectible, and I'm just abbreviating here, okay? But you'd write out allowance for uncollectible accounts or allowance for doubtful account of $18,600, and then that would give me a net accounts receivable. And I would put, notice what I'm doing is I'm putting the, since this is and we've talked about this in the last video, yes, I could just put the 158,000, sorry. I could put the 158,000 right here, all right? But that's single step, and I don't want to do that. most often I'm going to use the multi-step. So whenever I'm doing multi-step and I have a mathematical calculation, I always go one column to the left and I put the total of that mathematical calculation, which is designated by the single underline. I put that total amount of that calculation, into the right-hand column. So this is how I would actually show it on my balance sheet. The solution is showing the 158,000 here, and if you watch the last video, I explained why I wouldn't put it there. Is that wrong? No, it depends upon what your balance sheet actually looks like, but more often the balance sheet is going to be more complicated and not simplistic, so I would use the multi-step and put the number to the right. Okay. I think that maybe the authors were more intending this for you to understand what your net accounts receivable is. That's at least what I think the context of this problem is, in asking that question, what is your net accounts receivable? I really don't think that, I think they were just using that as a way of saying, okay, here's how we're going to show it on the balance sheet, but in order to know what my net accounts receivable would be. All right, so, all right, next problem. Let's see here. Wilson Auto's repair ended 2013 with accounts receivable of 85,000 and a credit balance in allowance for doubtful account of 11,000. So you know those two numbers. If I have 85 and I have 11,000 as my uncollectibles, that means I have 74,000 as my net accounts receivable, right? Which is what we did in the last exercise, right? But these are the things that kind of run through my head, all right, as I read through problems. All right, during 2014, Wilson's Auto Repair had the following activity. So this here is for 2013, and now it says during 2014 it has this activity. It says journalize Wilson's Auto Repair's activity for 2014. So let's see here. A, service revenue earned on account, 545,000. Remember, these are journal entries. So when you're making journal entries, follow that process. Again, if you don't think through the process, go back and watch the theory video under the student community there on the financial accounting on how to make a journal entry when you don't know how, and go through that thought process. Right, so service revenue earned on account for 545,000. So the first question I'm asking myself is, am I affecting cash? And because, no, I'm not affecting cash because it's on account. So the second question I ask is, am I affecting accounts receivable or accounts payable? Yes, because it's on account. Right. So I'm earning on account 545. So now that's accounts receivable, and since my accounts receivable is increasing, I'm going to debit my accounts receivable for 545,000. Debits have to equal credits, so I have to credit something else, and I'm earning it as service revenue of 545. Okay, so that's A. B, collections on account. All right. So 575,000. Well, if I'm collecting on account, that means, ask myself, am I affecting cash? Yes, because I'm collecting on the account. So my cash is increasing, so I'm going to debit my cash for 575, and I'm going to credit something else. Well, what am I collecting on? I'm collecting the on account. Well, on account is my accounts receivable, right? So I'm going to credit 575. My accounts receivable is decreasing. See how I'm using the thought process. I'm asking, 1, am I affecting cash? Yes, yes, or no. If it's yes, then I'm making the entry to cash. If it's no, then I ask myself, question number 2, right? Am I affecting accounts receivable or accounts payable? Yes or no? And if it's yes, well then I obviously use the accounts receivable or accounts payable. If it's no, then 3, I determine what is easiest for me to do, okay? I choose an account that's easiest for me to figure out, and I determine whether I debit or credit it. So whenever I decide to use cash or accounts receivable or whatever the easiest account is, I know I'm going to debit something or I'm going to credit something, okay? And since debits must equal credits, if I debit something, that means I have to credit something else. If I credit something, that means I have to debit something else, okay? And when I go to look at it, all I need to determine is which category of, asset, liability, equity, revenue, or expense that transaction is related to, and then look underneath those accounts under that category and choose the one that makes the most amount of sense. And what I end up doing is I end up backing into that account, all right? And by backing into it, I have more of a tendency to get the journal entry correct. Right? So that's the thought process. Right? C, write-offs of uncollectibles. Okay, so am I affecting cash? No, because I'm writing things off. Right? And if I'm not affecting cash, then I ask myself the second question, am I affecting accounts receivable or accounts payable? And that's yes, because I'm writing off what can't be collected, right? I'm not able to collect on my accounts receivable. And I'm writing it off, so that means I have to decrease my accounts receivable, which means I'm crediting my accounts receivable for 19,000. Okay. And if debits have to equal credits, then what account, am I going to use, right? Well, because we're not using the direct write-off method, okay, we're using the allowance method, which is determined, which we're being told here in the data, okay, then that means I would use my allowance for uncollectible accounts, and I'd take that $19,000 and I would debit that account. Because I know that, my mind is racing here, all right, so I'm starting to stutter. I'm writing off uncollectibles, meaning it's an accounts receivable. I'm not able to collect it, so I'm going to get rid of it, right? So that means I decrease my accounts receivable by crediting. Now, when I originally if I'm using the allowance method, I'm making an estimation on my bad debt. And when I determine that my accounts receivable, I'm definitely not collecting it, and when I want to take it off of my accounts receivable, I'm using the allowance account because that was part of it. That was the account that I use because I'm using the allowance method in and of itself. I'm not using the direct write-off method, which I would then make it to bad debt expense instead. Okay, if I was using the direct write-off method, then yeah, when my accounts receivable goes bad, I take it off the receivable and that goes to bad debt. But when I'm using the allowance method, I take it off the receivable and I put it against the allowance for doubtful account. And notice that, like I said, I'm just backing into that entry, right? So if I have a credit to accounts receivable and I have to debit something else, I ask myself, is this, am I affecting an asset? Well, yes, because when I look at my assets, I'm looking at my accounts receivable and I see the allowance for doubtful account there, the allowance for uncollectible account there. And knowing the method, using the allowance method, that's the account I use, because I had already written off, that's why I made the estimate, to bad debt, that I know that I'm going to back into and use that allowance account right there. I hope that made sense. Okay. If not, watch the video again, go back and watch the theory videos because you're not understanding the methods themselves. But if you still don't understand something, feel free to contact an instructor. Okay. And let's see, lastly here, D. Bad debt expense estimated as 3% of service revenue. Okay. So my service revenue, right, earned on account right here, which is this entry here, right, we're going to write off the bad debt expense. All right, so I'm going to debit my bad debt expense. So we're using the allowance method, and we're using the percent of sales method, okay, like it says right here. So we're going to write off our bad debt expense, but we have to figure out how much we're writing off. Well, if I had 545,000 in bad debt and I estimate 3%, I take 3% of the 545,000 and I get 16,350. So I debit bad debt expense for 16,350 and I credit the allowance for uncollectible account in the amount of 16,350, right? And that's the entry for D, right? And that, because we're using that method, okay, that is why we're backing into when we actually determine that the accounts receivable is bad, that's why we end up using that account there, because we're using this method right here, okay? Right, so hopefully that made sense and it came full circle. If not, watch the theory videos again, pause and rewind this video and watch it again if you have to. And if you still don't understand something, feel free to, telephone or email an instructor. All right, see you in the next video.